Imagine this. You have $900,000, but you want to buy a $1 billion house in Vietnam. Do you think you just need to work hard for a few more years? Completely wrong. The harsh truth is that in recent years, American capitalists have directly shown you how. The method? Incredibly simple. Just exchange Vietnamese dong for US dollars, then wait about 2-3 years and exchange back to Vietnamese dong. The result? You'll realize that because the US dollar interest rate has risen, everyone wants to exchange their money into US dollars to deposit in US banks and earn sky-high interest. So they sell Vietnamese dong, buy US dollars, causing Vietnamese dong to plummet in value. Not just Vietnam, but most currencies worldwide have also seriously depreciated. This is a smokeless currency war. I don't need to point a gun at you, but all your assets will be forced to be sold to me at a cheap price. Do you think the Federal Reserve has stopped raising interest rates and even started cutting them? Do you think this war is over and you no longer have a chance to buy a house at a discount? Wake up! A new round of currency war has silently begun. If even the capitalists of nations around the world are accumulating gold and you still haven't paid attention to gold, it's no exaggeration to say you will remain poor, or at least you won't be able to get rich. What does this mean? We'll dive in. If you are someone who wants to make more money or simply wants to protect your assets, then you must pay attention to the Fed's actions. But for professional investors like us, what we monitor is the Bank of Canada. Why? Part 1. Unveiling Market Secrets, Canada and the Gold Tsunami. Take a look at this chart. It's surprisingly simple. The blue line represents the Bank of Canada's assets, while the gray line represents the Fed's. When the 2008 financial crisis occurred, Canada's blue line rose earlier and faster than the Fed's gray line. That means Canada expanded its balance sheet sooner and injected more money than the US. The same happened in 2020. When Canada started unlimited money printing, the Fed only followed suit. Last year, when the Fed began adjusting its policy, Canada was also 2 months ahead. So, what can we conclude? Whether it's expanding the balance sheet or adjusting policy, Canada often precedes the US. This is also understandable. In a war, if you're the leader, would you be the first to charge in? Maybe in movies, but definitely not in reality. If you charge in first and fail, it's over. Therefore, you always have to let your subordinates test the waters, see how things are, and then decide to act. Think about it. If the US were the first country to cut interest rates and made a wrong decision, the market would panic immediately. That's why Canada is like a guinea pig for the US, always taking the lead. The US needs a country to test market reactions, and that's Canada's role. The question is, Canada has now announced that next month they will begin expanding their balance sheet and injecting money into the market. They are about to act. So does this mean the Fed is also about to follow suit?
Every time the Fed expands its balance sheet and prints money, gold prices skyrocket immediately. For example, in 2008, when the Fed printed money, gold prices doubled. By 2020, after another round of money printing, gold prices almost doubled again compared to before. So that means if we can invest in gold before the Fed prints money, then when that happens, our assets also have a chance to double. But how to invest wisely? In essence, the gold price boom is a new smokeless currency war. The assets of ordinary people not only didn't increase after the Fed stopped raising interest rates, but on the contrary, they depreciated even faster. Why is that? If you don't want to be a pawn in this war and even want to seize the opportunity to increase your wealth and change your economic class, then follow my channel. I will continue to provide you with more useful information. If you're worried about forgetting the content after listening, wasting your time, then like this video. This way, the video will automatically save to your playlist, allowing you to rewatch and follow along anytime.
Part 2. The Fed's Master Plan. Why Gold is Melting Hot. First, if you don't live in the US and don't actively seek news, you probably don't know that a month ago, I talked about 7 US states passing laws allowing gold to return as currency. Now that number has soared to 47 states. In other words, for Americans today, gold and dollars are both money. Both can be used to buy goods without necessarily using dollars anymore. What does this mean? As mentioned, if the Fed is about to expand its balance sheet and print money, the US dollar will immediately depreciate. But if, before that happens, the US government can get people to convert dollars into gold, then when the dollar depreciates, their assets won't significantly decline. However, this is just a superficial goal. The important thing to remember is, currently, both dollars and gold are considered currency.
So why has the price of gold risen so sharply recently? Because the US is preparing to impose import tariffs on gold. What does that mean? Suppose I am a gold trader. Currently, when selling gold to the US, I only have to pay a $100,000 import tax. But if the tax increases next month, I might have to pay up to $300,000. That means my gold business costs will increase significantly next month. To maintain profit, I will have to sell gold at a higher price. So, if I know in advance that taxes will increase next month, shouldn't I seize the opportunity to import as much gold as possible this month? This way, I still only have to pay the old tax rate of $100,000 instead of $300,000 after the tax increase. In other words, if I import gold now, I can save on the increased cost due to the new tax rate. So now everyone is buying gold in the UK and crazily shipping it to the US. Gold bars and gold ingots sold in the UK have almost been completely bought up. That's why gold prices have recently risen sharply. In fact, this is a new currency war.
So why has the price of gold risen so sharply recently? Because the US is preparing to impose import tariffs on gold. What does that mean? Suppose I am a gold trader. Currently, when selling gold to the US, I only have to pay $100,000 import tax. But if the tax increases next month, I might have to pay up to $300,000. That means my gold business costs will increase significantly next month. To maintain profit, I will have to sell gold at a higher price. So, if I know in advance that taxes will increase next month, shouldn't I seize the opportunity to import as much gold as possible this month? This way, I still only have to pay the old tax rate of $100,000 instead of $300,000 after the tax increase. In other words, if I import gold now, I can save on the increased cost due to the new tax rate. So now everyone is buying gold in the UK and crazily shipping it to the US. Gold bars and gold ingots sold in the UK have almost been completely bought up. That's why gold prices have recently risen sharply. In fact, this is a new currency war.
Additionally, as mentioned, many countries store their gold at the Fed. For example, Germany has half of its gold stored at the Fed, but cannot withdraw it. In the past, Germany requested to inspect the gold they stored in the US, but was denied by the Fed. That means, in addition to the gold owned by the US, there is a lot of gold from other countries being held in the US that cannot be withdrawn. In total, the US controls up to 15,000 tons of gold, and all of it belongs to the Fed's assets. So, when gold prices rise, who benefits the most? If you look at the Fed's balance sheet, you'll see that the value of gold reserves recorded over 40 years ago is still $11.04 billion. But now, that 8,000 tons of gold must be worth at least $810 billion. And this figure doesn't even include the gold that other countries are storing in the US. However, on the Fed's balance sheet, they still only record $11.04 billion, meaning the actual value has been underestimated by 70 times.
What does this mean? It means that the Fed has always deliberately hidden its true value. They do this by making the whole world believe that the most important asset they hold is not gold, but US Treasury bonds. Why? Because the whole world relies on the Fed's investment guidance. If the Fed prints money to buy US government bonds, bond prices will rise, leading investors worldwide to also pour money into US bonds. Buying US bonds requires dollars, so the demand for dollars will also increase, making people continue to believe that the dollar is the safest asset. But what's the current problem? US bonds are increasingly difficult to sell. People no longer want to lend money to the US because they are starting to doubt the US's ability to pay its debts. At this point, gold, an undervalued asset, can become a secret weapon. For example, I want to borrow $10,000 from you, but you think I can't repay and refuse to lend. But now, you discover that I have a heirloom worth $1 million in my house. It turns out I'm a rich second generation, a wealthy heir. Would you reconsider lending me money then? Similarly, over the years, every time the Fed expanded its balance sheet and printed money, the world felt the US was acting crazy. The US currently owes up to $36 trillion. But in reality, 80% of that is due to the US itself printing money and borrowing from itself to spend. Therefore, the amount the US actually owes the world is only about $7 trillion. If we put all these pieces together, we will see an astounding scenario.
Part 3. The Grand Plan, the Future of Currency and Your Assets. Now let's follow my reasoning once more. First, currently, out of 50 US states, 47 states have declared that both the dollar and gold are legal tender. This means the US is starting to put gold on par with the dollar. Is this preparation for the US to once again link its currency to gold? Second, next, the US announced it would impose tariffs on gold. Therefore, gold from all over the world is being transported at maximum speed into the US. So is the US's gold reserves increasing? At the same time, many people have forgotten that the US is already the country with the largest gold reserves in the world. Third, finally, gold prices are currently skyrocketing.
Do you see what's happening? What if the US restores the gold standard? What if the US declares it will use gold as collateral to issue dollars? What will happen? Currently, people use dollars and lend money to the US through government bonds because they believe in the US's credibility. But when confidence in the US begins to waver, when countries accelerate de-dollarization and no longer buy US bonds, what will happen? At this point, if the US links gold to the dollar and US bonds, the world may no longer believe in the dollar, but can they not believe in gold? The US used to be the country with the most gold in the world, and now it has even more gold. At that time, the US will declare to the world, feel free to use dollars and buy US bonds, because even if I can't repay, I still have gold as collateral. Thus, gold prices surge at the time the US accumulates the most gold. If the US doesn't have enough money to spend, they can use gold as collateral to borrow more money from the world. Even one day, the US could directly use gold to issue dollars and officially restore the gold standard. At that point, as long as the US holds gold, they can continue to print more money.
Furthermore, if the US prints $1 trillion through financial leverage in the banking system, this money can multiply into $10 trillion to spend. And because every new dollar issued is backed by gold, people will believe that this currency has real value. In simple terms, the US wants to tell a story to the whole world. Because I hold gold, both the dollar and US bonds are valuable. They will not become worthless pieces of paper. Do you see it now? The US is making a master move, turning crisis into opportunity, luring the entire world into its trap. Currently, the whole world is rushing to buy gold instead of US bonds. But if both gold and bonds are in US hands, the outcome remains unchanged. Last year, when we started buying gold, it was also when gold entered an uptrend. The most important reason was US bonds had entered a bear market. Why is that?
Traditionally, countries doing business with the US, especially China, after selling goods to the US and receiving dollars, would often hold on to the dollars without immediately using them. But the dollar continuously depreciated due to the Fed's money printing policy. Therefore, China and other countries often used dollars to buy long-term US bonds to earn interest, both preserving the currency's value and being able to quickly liquidate when dollars were needed. However, when the debt crisis occurred, a major event happened. The US directly froze Russia's assets, foreign assets. Suppose you spend a large sum of money to buy a house. This house is indeed yours, but you cannot move in, nor can you rent it out for profit. You only have ownership rights, not the right to use it. This is really very inconvenient. Perhaps for that reason, China has begun to reduce its holdings of US bonds. However, this reduction does not mean China is selling off US bonds on the market, but rather that when bonds mature, they are not reinvesting in US bonds. In other words, China used to lend money to the US, but when the US repaid the principal, China did not continue to lend. After recovering this money, China continuously bought gold and transported it to the central bank's vault for safekeeping, ensuring that no one could confiscate or freeze their assets. Meanwhile, the U.S. raised interest rates, causing U.S. bond prices to fall sharply. This was the reason for the collapse of many U.S. banks. Previously, these banks often bought a large amount of U.S. bonds, even using financial leverage to amplify profits. But when bond prices fell, the value of their assets also plummeted significantly. If they sold, they would suffer heavy losses. If they held on, they would face liquidity problems, leading to bankruptcy. Not only China, but Japan and the UK also significantly reduced their U.S. bond holdings last year. After that, they also started buying gold. There are four main groups that buy gold. The first group, industrial enterprises. They buy gold for use in production. The second group, those who buy gold for jewelry or luxury goods. These two groups do not significantly impact gold prices. The most important groups, the third and fourth groups, central banks and investors. Central banks buy gold according to national policy, often accumulating for the long term and not selling. Investors, seeing central banks around the world aggressively selling U.S. bonds to buy gold, will also follow suit. Therefore, in recent times, U.S. bonds have plummeted while gold prices have soared. But this is just the beginning. As mentioned, if gold can be used as currency and the U.S. continues to drive up gold prices, then this will be a new currency war.
Conclusion: protect your assets now. Even if the U.S. doesn't raise interest rates, and even if the world no longer lends money to the U.S., global capital will still flow to the U.S. Why? Look at recent reality. When gold prices rise, a flood of people rush to buy gold bars and ingots to participate in the market. This is equivalent to them taking their domestic currency and exchanging it for gold. Meanwhile, many gold ETFs and gold futures contracts still have to be traded in US dollars. As a result, currencies worldwide are being sold off and continue to depreciate. During the period when the U.S. raised interest rates, many currencies like the Japanese yen and the Korean won plummeted. Some countries like Egypt, Argentina, and Brazil even saw their domestic currencies collapse. Now, even though the U.S. has stopped raising interest rates, gold prices continue to climb, causing other currencies to continue to depreciate.
This means, previously, the U.S. used interest rates to attract global capital into the U.S. banking system or short-term bonds, severely affecting the exchange rates of other countries. Currently, even though the U.S. has lowered interest rates, they can still use the rising price of gold to pressure the exchange rates of other countries. If you add Trump's tariff policy, which makes goods from exporting countries to the U.S. more expensive, then most countries have no choice but to actively devalue their own currencies. This way, their goods will be cheaper, helping to reduce the impact of tariffs than maintain export orders. However, this also means that the domestic currency will continue to depreciate. As an investor, when you witness your country's currency continuously depreciating, your assets gradually shrinking and being sold cheaply to the U.S., what will you do? Or even if you're just an ordinary citizen, you'll find imported goods increasingly expensive and living costs continuously rising. In that situation, would you consider transferring your assets to the US or to safe investment channels like gold, US dollars, and US bonds?
Especially, many businesses borrow in US dollars. Suppose you borrow $1 million from me, equivalent to about 25 billion VND to do business in Vietnam. If after 1 year, the Vietnamese dong depreciates, that 25 billion VND might only be worth $800,000, and you still have to pay interest on the initial loan. When you can't repay, your business will go bankrupt. At that point, your collateral assets like stocks or real estate will belong to me. Take the 1997 Asian financial crisis as an example. At that time, Thailand owed all $90 billion, but the baht was heavily shorted by large financial speculation funds, causing it to depreciate severely. Thailand was forced to use its US dollar reserves to intervene, but because the dollar-denominated debt was too large, they couldn't cope in time, and the financial crisis erupted. As a result, decades of accumulated assets of the Thai people evaporated in an instant. When assets depreciated to the point where they could no longer fall, American capitalists with their strong dollars came in to buy them back at cheap prices. Not only Thailand, but Japan and South Korea also experienced similar situations. If the Federal Reserve continues to expand its balance sheet and print money, our currency will continuously depreciate. If the trade war and currency war truly develop in this direction, then gold could become the safest asset in the world, even with the potential for the strongest price increase. That's why more and more wealthy people around the world are accumulating gold. Those who do not own gold during this period or do not allocate assets to gold may lose their assets invisibly.
Besides physical gold, like gold bars or ingots, ordinary people can still benefit from the rising price of gold through ETFs. Personally, whenever I make a profit, I regularly buy a certain amount of physical gold and hold it, never selling. For me, gold is the best safe haven asset and also the true currency. And if gold enters a strong uptrend and I want to profit from it, I will trade gold futures. For beginners, a simpler way is to invest in gold ETFs like GLD or IAU. These are large and popular funds. I'm not advertising. I just want to say that these ETFs are all denominated in US dollars. That means you have to convert your money to US dollars before buying. Therefore, a prerequisite is that you must believe that your currency will depreciate while the US dollar and gold will appreciate. If you have that belief, you can consider investing in these ETFs.
Most importantly, you need to understand what low-risk buying and selling points are, how to evaluate the profit-to-risk ratio, and the criteria for selecting investment assets and stocks. You cannot rely solely on intuition without clear standards or conditions. Currently, gold prices have risen a lot and are at risk of correction. If you rush to place an order now, you could easily get stuck. You might buy and the price immediately drops. Or even if it rises later, it could still sharply decline again. All of these have their own rules and systems. Currently, the Federal Reserve has temporarily paused interest rate cuts. The stock market is constantly fluctuating without a clear trend. So, what will the market do next? How should we invest? Due to time constraints, I will stop the video here. I share free knowledge about wealth creation, business, investment, and how to achieve financial freedom. If you don't want to miss out, follow my channel, turn on notifications, and share this video with more people. I wish all of you to achieve financial freedom soon. If you can find just 1 or 2 useful insights from what I share that help you improve your life, then I will feel content.